This original WSRE presentation is made possible by viewers like you. Thank you.
Good evening, I'm Lloyd Patterson. This is CTC, Connecting the Community. Taxes are tonight's target issue. First up, the federal estate tax, or death tax as some call it. Did you know there's no estate tax this year? Zero. The controversial tax expired at the end of last year, and Congress has done nothing to reinstate it. And with an election coming up, it seems any action is unlikely. So in January, the estate tax reverts to its 2001 level, an exemption of $1 million and a top rate of 55% on the largest estates. Now, our guests are two experts who grapple with the changing laws or lack of them every day. Bill Linney is a Pensacola attorney with a degree in accounting and a master's in taxation. He serves on the panel that certifies attorneys in the field of taxation. Dina Muldowney of Niceville is a partner in the Destin-based CPA firm Carr, Riggs & Ingram, among the largest CPA firms in the country. She specializes in estates, trusts, and elder care planning. She's a CPA with a master's in accounting. We welcome you both. Thank you for being here to talk about some tough issues and issues that involve a lot of numbers, but at the heart of it, there are some basic concepts. We have to have taxes to pay the bills for the country, of course. What is it about estate taxes, do you think, that makes them so controversial every time you hear about them?
Well, I would not say they're controversial except for the people that have to pay for them. It seems that they were passed initially during really became effective during the first Depression, and they were designed to basically provide a means for leveling the people's wealth every few generations.
It was a social mechanism.
Social engineering. Yeah.
I think it's controversial because it's almost like a double taxation. You work all your life and you pay income taxes on, the earnings that you have, and as great Americans with all the opportunities that we have, we use those earnings to purchase assets. And then when you pass away, you're taxed on those assets. And so it's like almost a form of double taxation.
And the people who call it a death tax tend to argue, what is it about dying that should change, that should entitle the federal government to part of my big chunk of my money?
Some people say that it's just an easy way for the government to tax you at your most vulnerable point in time, your death.
You're not likely to.
You can't really defend yourself very well after you die.
They say it's easier to tax a dead taxpayer than one that's alive. So.
Yeah. But the dead taxpayer tends to have relatives who care
That's right.
great deal about that.
Mm-hmm. Well, and part of I think the satisfaction that both of us get about what we do is when we're meeting with our clients. For lawyers, you're usually dealing with, in other matters, with people who are thinking about themselves. Well, when people are doing estate planning, they're thinking about other people. They're thinking about their children and their grandchildren and trying to protect them. And so by saving taxes, we're not saving the mother and father any taxes, because in the simplest possible plan, there won't be any taxes due until both of them have died. So we're trying to save taxes for families, and it can be very satisfying.
And some of the benefits to estate planning go beyond just saving taxes. If anybody has experienced a death in a family, it's very traumatic and it's very stressful for months afterwards. And so when you put an estate plan together, you're kind of, laying out a game plan. And so it makes it a lot easier for the beneficiaries because everything's laid out and they don't have to make assumptions. What the decedent wants is written in a plan. So it makes it easier for everyone.
And at what income level does that make sense, Dina? to do an estate plan?
Well,
right away?
first of all, it doesn't matter what your income level is. You definitely need a will. You know, a will and a trust are kind of, and power of attorneys are basic estate tools that everyone needs. You know, but as your assets increase, do you
It's
have
assets
a dollar?
rather than income.
Well,
Yeah.
actually, I would say the smaller a person's assets, the smaller the value, the more significant the costs associated with dying become. And so for the person with just a few dollars, a home, a retirement account, some life insurance, the costs of probate, or if they become incapacitated, guardianship, are a larger percentage of their assets than would be the person who was worth $100 million. So I think it's more, in terms of a percentage of assets, it's more important for a person to do estate planning who has isn't in the $1 million figure for estate taxes. It's still just as important, maybe more important.
If you just joined us, you're watching Connecting the Community here on WSRE, PBS for the Gulf Coast, and this program is our first local program that we're broadcasting in HD, something that has been adopted in recent years by all television stations. So anyway, if you notice that your picture looks great, but your moderator doesn't look as good, that's because of this HD picture. That's the thing. We're talking tonight with a couple of tax experts about different taxes, different federal taxes, but first of all, estate taxes. And I made the point at the beginning of the program that in 2010, there is no estate tax. And it turns out, according to Time magazine, they quote a study that shows that there seems to be a relationship between death rates and estate taxes. That, in other words, people, how do you put this delicately, speed up the death process if they think their heirs will benefit by their demise. Is that shocking? I mean, taxes have an impact.
I don't know that I'm experiencing that. It does seem like more people are dying this year, but I don't see any guilty looks on the children's faces.
Yeah, that's a hard connection to make, isn't it?
Well, you don't recommend that, obviously,
that's
as
not
a
good
course.
planning. In fact, I would say most people that do their planning, they need to assume, and most people do, that they will be dying sometime after the first of this coming year. And that's where our Congress has let us down, because we do not know what the law is going to be on January 1, 2011. We don't really know what the law is right now, because there are proposals that have been submitted. The House has passed a bill that, if the Senate approves it, would retroactively to the first of 2010 impose an estate tax.
Of an estate tax that would
and the
go
estate
to,
tax would be on the states for people who have more than $3.5 million in assets. And that's a lot of money, and most people won't face that. It's even possible, if Congress wanted to pass a retroactive bill. I think it might be unconstitutional, that could make it $1 million effective January 1, 2010.
if they go back to the 2001 level. $1 million, that's a lot of money, isn't it? Most people don't have $1 million. Is that an unreasonably low level, do you think, for a state tax?
I think going back to 2001, as professionals in this arena, we really never thought that the state tax would be repealed. You know, we've all been making bets since 2001 on what we thought would happen, and we all lost those bets because we never really thought that this estate tax would get repealed. And then even in June, we felt like, you know, we had a good insight on what would probably happen, and nothing's happened. So I think it's a little bit astonishing to us that, you know, there's a good chance it could go to $1 million on January 1st.
And that would be unfair, do you think, Bill Linney, or would that be just about right?
I think that would be very unfair for Congress to allow that to go back to $1 million. I certainly don't think, even President Obama proposed when he was running that the unified credit remain at $3.5 million.
And we're talking of a tax rate to go up to 55%. So
And the
that's
maximum rate would have been 45 had campaign promises been met, but they weren't. And I think we talked earlier about the fact that the most recent conversation I had with an IRS auditor, he indicated, I said, well, what do you think is going to happen? Because he may have more of an insight. And he said all he knows is he's been told, and the IRS has been told, to gear up for it going back to $1 million in 2011. Now, the point that I made is that he tells me that right now in the entire United States, there are only 300 federal estate tax auditors. There used to be years ago when the unified credit was only 600,000. There were thousands of them. He says that if it goes back to $1 million in 2011, they'll need 4,500 auditors, and they only have 300. And they are not geared up to hire 4,300 lawyers. That's not the best way to hire lawyers.
So these cases could possibly stretch out for years and years.
If it goes to that, it will be a big mess.
Okay, going back to the philosophy behind why we have an estate tax. Former Treasury Secretary Rubin wrote in a Wall Street Journal a piece that I'll just quote briefly. It said that the estate tax is grounded in powerful philosophical underpinnings. Our nation views itself as a meritocracy and a land of opportunity. We have a proud legacy of upward mobility. An estate tax helps us promote this legacy by avoiding the accumulation of inherited economic and political power and wealth. Is that, do you think that's a legitimate thing for the government to do, to knock off the top off of some of these wealthy estates?
You're asking Bill Linney, a Republican, if he agrees with that philosophy. I think that is terrible policy for our federal government to have. I think it discourages. One of the reasons why I have worked hard all my life is for my two children. And for them to say, I don't think that your children should benefit from the hard work that you've had, that's not government's role. It may be, I can see Mr. Rubin, who's worth a couple of $100 million, may think it's appropriate, and it probably would be. I don't have a problem with Mr. Rubin paying his children paying $190 million in tax if he wants to level the playing field. But my little bit that I have, that if this goes back to $1 million, I would much rather my children receive that money than our government that would use it in the wise ways they've been spending it over the past few years.
Dina, what do you think about the philosophy behind the whole idea of having an estate tax?
Well, I'm kind of like Bill. You know, I'm not an advocate for taxes that punish hard-working Americans. You know, the fact is that our country's in a deficit situation, and that's a tax revenue raiser. And I think that's what the country's looking for right now.
And the Congress is going to be looking very carefully, I'm sure, at every possible source that can get its hands on for revenue. And the estate tax, it seems like, would be a very attractive way to get that money.
The estate tax generates a very, very, very small portion of the taxes that our government generates, less than 1%. Less than 1%. And yet it produces all kinds of fees for people like us to try to avoid it. The real, I heard a talk one time by a Democrat who was from a poor district in New Orleans, who said that he was against the estate tax. He said that he knew that most of his constituents wouldn't pay the estate tax. They wouldn't have enough money to pay that. But he knew that if they ever had enough money to pay it, they wouldn't want to pay it. He really was against the estate tax, and there's one rule in the estate tax law that is beneficial to everybody. If you die and have an asset that cost you $1,000 that's worth $10,000, and you leave it to your loved one, for income tax purposes, it's as if that loved one went out and purchased that asset for $10,000. If they sell it the next day, there's no income tax on it. One of the things the repeal of the estate tax was going to do was to change that rule for wealthy people so that they would, when people inherited their wealth, they wouldn't pay estate tax, but they would not also get that increase in basis. So that Sam Walton's children, when they inherited the Walton stock, Sam maybe had $1 basis in his $45 per share stock. They would get their dad's $1 basis, and then when they sold the stock, they'd base some capital gain. That was the trade-off with the repeal of the estate tax. And this congressman said that will generate more taxes for the government if they did that. And it actually allows the people who inherit the tax to decide when they want to pay it. They can not sell the tax and not pay it. But when you die, the tax is due in 9 months.
Well, we have a lot more tax questions that we want to ask our experts about, and we'll continue with them right after this short message.
Hi, I'm Jeff Rogers with Gulf Power. And if you're looking for ways to save money and energy, the answer could be right under your feet. Geothermal heating and cooling is the most efficient system available. It takes advantage of the Earth's constant ground temperature and special pipes below the surface that transfer heat, supplying warmth in the winter and cooling in the summer. It's a durable system that dramatically reduces heating and cooling costs. Information about geothermal and other EarthSense programs is available toll-free and at gulfpower.com.
Be more connected with WSRE. Find us on Facebook. Follow our tweets on Twitter. Watch our videos on YouTube. And get even more at WSRE.org. WSRE is working to help you be more informed on the Deepwater Horizon oil spill. Visit WSRE's oil spill website at WSRE.org/oilspill to find the links you need and the information you want. You'll find emergency phone numbers, links to government and area resources, and links to the BP claim site. WSRE.org also has exclusive video coverage of town hall meetings, area presentations, and local forums providing insight into the potential long-term effects on our community's mental health, legal options, and economic recovery. On WSRE.org, parents and teachers can find tools to explain the science of an oil spill and its environmental implications in terms kids can understand. At WSRE, we're not just covering the oil spill, we're living it alongside our viewers. You can depend on WSRE to help you be more informed. WSRE, PBS for the Gulf Coast.
Donate your old boat to WSRE. Call 1-866-770-WSRE.
Welcome back. I'm Lloyd Patterson. This is CTC Connecting the Community. Tonight our topic is the tax code, and that's produced some interesting answers from our guests tonight. We have two real pros in this field. Bill Linney is an attorney with a degree in accounting and a master's in taxation, and Dina Muldowney is a partner in the Destin-based firms Carr, Riggs and Ingram, and they're answering questions about tax. We've been talking mainly about the estate tax. Before we leave that, I want to ask you about, we know that taxes have an impact on people's behavior. What impact does some people who are able to write big checks to organizations, to nonprofits, to places like WSRE, to the University of West Florida, it's Sacred Heart Hospital, et cetera, what impact does the estate tax, or lack thereof, have on people writing these big checks?
Well, charitable deductions play a big role in estate planning, so I think you're correct, and that it's probably a motivator. Estate taxes is a motivator for charitable giving. Gifts to charities reduce your estate, so it reduces your estate tax. And there's a lot of vehicles for giving during someone's lifetime, and those vehicles can reduce an estate when that person passes away. So estate tax is a motivator, I think, for charitable giving.
Bill Lenny?
Well, I think that the panel discussion that I was describing, the Democrat that was for the repeal of the estate tax, also on that same panel was a Republican who was against the repeal of the estate tax. And I was struck by the difference there, because you would normally expect a Republican to be for the repeal and the Democrat to be against it. The Republican was for keeping the estate tax because of the incredible encouragement it provides very, very wealthy people or not so wealthy people to make gifts to charity. You know, the two of the big supporters of the return of the estate tax are Bill Gates and what's his name, the wealthiest man in the world, whose name I can't
Warren Buffett.
Warren Buffett. They're really supported because they probably are going to give 90% of their wealth to charity.
And are doing so now.
And they have already. Bill Gates has the largest charitable foundation in the world. And they're for that because they realize that if they gave away 90% of their wealth, 10% of their wealth is still more than enough to take care of their family. And in a lower economic level, it also, if you're going to make a gift to charity, to WSRE or a church or whatever, one way to look at it is if you give it to charity and there's an estate tax, it's really only costing the family, if you have an estate tax situation, 55 cents on the dollar, because the estate tax right now, or was 45%.
Okay, let's jump to we're running low on time.
Okay,
Let's jump
sure.
to the income tax rates. There's been a lot of controversy. Congress is debating over what taxes to raise at what levels. So the 2010 tax rates I want to put up on the screen. There are quite a few numbers here, but let's just basically at the bottom rate, you get taxed 10% of your income up to just over $16,750. But want to look down at the bottom. It's 35% on incomes over $373,000, and the administration wants to bump that up to about 39.5%. What impact does most people don't come close to $370,000 on their income? Why should they care if these people with these super high incomes have to pay more federal taxes?
Well, first of all, in 2011, that 10% rate, the lowest tax rate, will go to 15%. So that will affect many Americans as well. But, you know, I don't know the percentage. I'm going to say like 90% of all income tax is paid by people who make over, you know, $120,000. So the increase in the tax rates that will be in effect for 2011, in my opinion, will cause everybody to pay additional taxes.
Okay, it's not just the super wealthy. It's the $250,000 level is a level you hear most about on the news, the one that the administration really wants to kick up there.
Well, if you really think about it, if you raise the tax for people who are making more money, the people who are making more money hire people. If they have less money, they hire fewer people. It causes more unemployment. It produces more deficit problems. And so the theory is that by raising those taxes, especially right now when we're obviously going through a difficult financial situation, by raising anybody's taxes, we're reducing jobs.
Okay, is the $250,000 level, is that that's not the income, that's not the job generator income. The income is getting up there probably, these would be mostly what, small businesses?
If you're making,
You would be surprised.
if you're making
though.
$250,000, you are probably
I agree.
helping employ 4 or 5 people.
And the small businesses, you know, like Bill was saying, you know, from 50 to 200,000, I mean, they're employing people. So increased taxes affects everybody, and it does in the long term hurt our economy.
So even if you're talking about raising these incomes and people maybe picture some fat cat out on the beach retired and rolling in the money, it's more likely the person who has, a couple who has a small business and that
Working 60 hours a week, you know, paying health insurance, trying to keep people employed.
Well, you know, the other thing to remember that in 1959, the highest income tax bracket was 90%. And the reason why those rates were lowered was that it had a dramatic impact upon employment. And so Congress over the years reduced the rates and employment actually improved. The employment situation jumped dramatically when the Bush tax cuts were in place in 2003. It really was great for the economy. We did have a good economy until 08, 09. And it was largely a result of the Bush tax cuts. Now, the problem was they cut taxes and they increased spending, and that created all kinds of problems. When you cut taxes, eventually you ought to cut spending. And
unlikely to happen.
Well,
though.
but that's what has to happen,
Right.
because we can't continue the way it's going.
Down to our last few moments, capital gains tax. Talk a little bit about that. If people who've bought some stocks, say earlier this year, I don't know how many people are gaining on stocks these days, but is this a good time do you want to sell stocks before the end of the year?
Well, the capital gain rate in 2010 is 15%. It'll go up to 20% in 2011. And just remember that you can also gift stock and avoid the capital gain and support a charity.
Okay.
But I think your observation, tell me somebody with some capital gains.
That's the
They
problem.
might have some capital gains, but they're probably down considerably, and is now the right time to sell anything.
Right.
That's the reason that nothing is selling, and that's the reason our economy is stagnant, because it's slow, and they're.
What's happening to all these losses that businesses and people are experiencing because of real estate?
Well, if they have losses, you got to have income to offset the losses. They're not getting any tax benefit from those losses because they have to have income.
Mm-hmm. Investment losses, you're limited to what you can take to $3,000, and they'll carry forward. One thing about the business losses, though, you can carry those back 2 to 5 years and get a refund of some taxes that were paid in previous years, which can help your cash flow.
Okay, we're down to our last minute. I want to tell you how much I appreciate you coming over here. I think you have impossible jobs trying to stay on top of all these different tax laws. Don't know how you do it, but we're glad you were here. Bill Linney, Pensacola attorney, a tax expert, and Dina Muldowney from Niceville with Carr Riggs Ingram. We appreciate your being here, and thank you for watching Connecting the Community here on WSRE PBS for the Gulf Coast.